In this presentation, we will discuss rental property and vacation home as it relates to income taxes. Note that if we have some type of property, some type of real estate property, we could be holding that property for different reasons. We might be holding it to have a vacation home that we use periodically. We might be holding that property in order to get rental income from it and be renting it. Or we might have property just simply as an investment, not renting it at all, but hoping that the value of that property will go up over time. There will, of course, be different tax consequences depending on the use of that property or what that property is for. And we also have those confusing situations where we have property that we both rent it and we use it for personal use as well. What do we do in those situations? Those are going to be some items that... For more accounting information and accounting courses, visit our website at accountinginstruction.info. We'll touch on here. Property used for both rental and personal. There's going to be three categories of property used for rental and personal. They could be primary rental. So from a tax perspective, we're going to say, okay, you use it for both rental use and personal use. Is it primarily rental, or is it primary personal, or is it personal/rental? These are the three categories we need to categorize in order to then discuss and think about what the tax consequences will be. So then how do we know which category this falls into? We need some pretty specific rules that we can go by in order to categorize these and not just categorize them arbitrarily. It's determined by using the number of rental days used compared to the number of personal days that are going to be used. Personal use is used by the taxpayer, family, or non-family with no charge. In some cases, it may also include the use of family members at cost with no profit. But in any case, the comparison will be the personal use then compared to the number of days that we have for the rental use. Also important to note that if the time that we spend there is time that we are working on the property, then that's not going to be included as personal use. If it's upkeep, if it's maintenance that we're doing there, then it's not the time that is personal use. The category of primary rental. This is kind of the one you would want to be in most of the time. You're going to get the most benefit oftentimes if we are categorized as a primary rental property, and it would be needed to be used no more than 14 days for personal purposes or 10% of total rental days, whichever is greater. If that were the case, then we might be able to qualify then that property for primary rental, typically having a beneficial tax consequent as opposed to the other categories. All income and expenses are reported on Schedule E then, so we're going to report this on Schedule E. Expenses must be allocated between personal and rental use. So if we know that the expense is of course personal as opposed to rental, then we need to allocate those out and record the rental expenses on the Schedule E. Losses are allowed against other income up to $25,000 subject to passive activity loss rules. Note that the rental property is one of those areas where it's quite possible to hold on to property and be able to have losses on those property. And really, the property is being held for possibly the gain or the capital gain, maybe rather than the rental. And it was thought then that the rental property should be passive activity and not be allowed to take the losses on the rental property. And that's why the rental property is a little bit different in some cases, or one reason it's different type of business activity and needs a separate schedule and has some passive activity limitation, passive activity rules, which kind of limit, in essence, the amount of losses. So it's common to have losses on rental property, in other words, part of the reason might be that the rental property is being held not just for rental income, but for capital gains. And so then, of course, there was an exception, and basically $25,000 in many cases is something that is a cap kind of that can be deducted for losses on the property. So just be aware that, of course, the IRS, from an IRS standpoint, they're skeptical of losses. Anytime we have losses and we take those losses and apply them to other income, so if we have rental income, we have a loss on the rental income, we take that loss and apply it to other income, that's when the IRS is going to be a little bit more skeptical, of course, because now we're not only claiming no income on the rental property, but we're claiming a loss, which we're then matching up against other income from other sources. And that's where we get into rules like passive activity rules and the like. Then we have the primary personal. So what is it to have a category of primary personal? Now note, this is probably like the worst category from a tax standpoint. If it's primary personal, then we may not be able to write off many of the expenses. So rented for less than 15 days and is used for personal residence. If that is the case, income derived from the rental period does not have to be reported. So that's going to be kind of nice. We're going to say, okay, if it's primary personal and you only rented it for 15 days and the rest was personal residence, well then whatever income you got for those 15 days, not going to have to report it. However, the expenses are also not deductible unless they are allowed as an itemized deduction. So in other words, you can't write off, and remember then that if we don't have much income, if we didn't rent for much time, like 15 days, it's quite possible that if we were to record, say, a Schedule E, we would end up with a loss because we'd have more expenses than income, and then try to record that loss against other income. And that's what the IRS is going to say. No, you have a primary personal residence here, and we're not going to allow the loss. We're not going to allow any expenses, basically. And therefore, we're not going to have a situation where we have this loss situation that we have to deal with and talk about passive activity rules and see if we're going to allow the loss. We're just going to say, hey, we're not going to have any Schedule E, and any income you got for that 15 days, that's fine. You don't even have to fill out or report it. So it's kind of good that we don't have to report the income, but on the other hand, it's quite likely that if we were to report it, we would end up with a loss and be able to deduct that loss if it weren't for the fact that it's primary personal property. Now, note that if we may get some deductions in other areas. So we may get to still deduct the mortgage interest and the property taxes, for example, as Schedule A type deductions. We just can't deduct them as rental property on the Schedule E. So we're talking about rental property. The property still then may qualify for things like state taxes or some type of mortgage interest for our residence type of deductions. So it could be deducted elsewhere. If we did have the Schedule E deduction, then again, it might be oftentimes a more beneficial place if we were allowed to deduct it on the Schedule E, because there's less limitations typically in terms of getting the full deduction on a Schedule E type of deduction. Now, what if it's personal/rental? What does that category mean? This is the third category, personal/rental. It's used more than 14 days for personal purposes, or 10% of the total rental days, whichever is greater, and rented for 15 days or more. So now we're over the 15 days of rental and use more than 14 days for personal, or 10% of the rental days, whichever is greater. Income and expenses are reported on the Schedule E. In this case, expenses are allocated between personal and rental. So we're going to have to use some type of course, allocation method now because we're personal/rental here. Expenses are only deductible to the extent there is rental income. Loss is not allowed. So notice the difference here. Again, the big issue with the loss is on the rental property, where it's quite likely that many people have losses on the rental property that they want to try to deduct against income somewhere else. And that's going to be one of the big kind of issues. So if it's not rental, primary rental, if it's personal/rental, then we're going to be limited to the losses. If there's losses, we can only take the expenses up to the losses, and then we can't take the losses over. And that's going to be a big difference between the categories that we have. For more accounting information and accounting courses, visit our website at accountinginstruction.info.